Welcome back to our third lesson on how to use the V-formula framework to evaluate a potential investment in a company. I'm Chris Volk, CEO of Store Capital. In our last lesson, we began to discuss how to evaluate a public company using this approach, and we ended up computing the investment required to create the public company. So now we're going to turn to compute the proportion of that investment which the public company is funded with OPM or other people's money. You can be basic and just add up the debt, convertible debt, and preferred stock amounts. Or you can use my approach and add in the off-balance sheet obligations such as leases. Here I take a simple approach and just divide the rent payments by my estimate of the market rent yield requirements for the assets being leased. The idea is to approximate the cost of those lease assets that are being deployed. Conventional wisdom and accounting principles tend to focus on creating a present value of a lease obligation, which is really incorrect for our exercise. Were we to do this, one could never compare, say, one company that rents all of its real estate with another that owns all of its real estate, because the cost to create the businesses would diverge. Moreover, trying to compute the present value of a liability misses the point that the business will invariably either continue to rent that asset upon lease expiration or replace that asset with another similar asset. So, with the value of lease assets determined, I add the capitalized lease asset amount to the investment in the company, and I also add that amount to the amount funded with OPM, since lease assets are fully financed. I then make an estimate of the annual maintenance capital expenses, which is usually in the area of 2 to 4% of the total investment amount. And I make an investment of the interest rate too, which is the interest, preferred stock payments, and rent payments divided by the amount of OPM that's used. With this work, which does take time, you can derive the 6 variables that go into the V-formula. And just as a reminder, here are the 6 variables. Sales, the investment. I tend to use balance sheet assets at cost plus rent expense divided by a market lease rate. Operating profit margin, interest rate on OPM, which is the interest expense and rents divided into the contractual balance sheet obligations and capitalized rents. Proportion of the investment funded with OPM. The annual capital investment. The proportion of that investment which is funded with equity, which is 100% less the proportion of the investment that's funded with OPM. Now, like I said earlier, when you purchase a company's shares, your investment will likely be higher and potentially much higher than the company cost to create. So, from the V-formula you have created, you can determine the approximate cost of the company's equity, which will generally bear only a loose resemblance to the company's book equity value. After all, equity, as I mentioned in an earlier lesson, is basically a plugged number. Welcome again to the many differences between finance and accounting. What's the difference between the value of equity and the actual cost? Well, just compute the equity value of the company by multiplying the number of shares that company has outstanding by the share price. Or make it easy on yourself. Just look at the equity market capitalization up on any financial website. By doing this, you can compute what I call a market V-formula. This is just adjusting the equity investment and the total investment by the amount of the difference between what you have computed already as the equity cost and the market value of that equity. By the way, that difference is generally referred to as market value added, or MVA, which is the term Stern Stewart coined in their work on economic value added, or EVA, which I encouraged you to look up in an earlier lesson. Market value added is the amount of shareholder wealth created in excess of its cost. From our work in prior lessons, you should know that this added value was created by generating equity rates of return that exceed those required by investors in companies having similar investment qualities. So just take the MVA and add it to the initial investment amount to create the company, since it's the new cost for you, and also to the original equity cost of the company. With those 2 adjustments to lines 2 and line 7 of the V-formula, you can now compute the market V-formula. Now, you can use the market V-formula to compute your expected current pre-tax rate of return from your investment in a public company. It's useful to know, but it will not be the same thing as computing your total expected rate of return. To get there using the V-formula framework is going to require a little more work, which we'll review in our next lesson. Until then, I'm Chris Volk, and thanks so much for joining me on this value creation journey.